Good morning. If I could have folks' attention for a second. I want to thank everybody for being here this morning. I want to thank Secretary Geithner for coming to address the club. I want you to know how you test a very successful Treasury Secretary. We had dinner last night, and as the bill came, Tim left. And I think that is a standard of a very successful. Exact timing is everything in the market, and he knew exactly when to get up from the table. The truth is, both of us exercise a lot, and Tim was smart enough to get out early so he can get up and get his workout done. I have known the Secretary since our days in the Clinton administration, and he and Carol are good friends of Amy and I. In fact, his wife was here about a month ago, and Amy held a book party for her new book, which is very, very good. Everybody's required to buy it on the way out today. The serious is, we're now 3 years into the president's administration. And if you go back 3 years, there were many a day and many an evening in the Roosevelt room trying to figure out how to deal with both the economic recession that's now known as the Great Recession, the collapse of the financial markets, and the auto industry. And as I like to say, any one of those are worth a full term, and all of them had to be dealt with in the first 3 months. And I remember many times Tim's advice to the president, and when you go back and remember the stress tests for the banks, building basically all the actions, rebuilding confidence in the market, and rebuilding confidence in the economy and getting it moving again. His advice, his counsel, his decisions that he counseled the president were very important for helping us get to this point that we're now talking about a level of job growth that went from 800,000, 700,000 lost jobs a month to 200 to 250,000 job gains a month. And that is obviously a major, major swing over the last 3 years. Not only is he a dear friend, but I think we have been very fortunate as a country to have him as our Treasury Secretary, and I think it's been very fortunate to have the President. It's been very fortunate to have him by his side. And I cannot think of anything more important that as Tim begins to go around the country to talk about the economy, the decisions we have yet still to make to help strengthen the early stages of this recovery, that he's decided to come here to the city of Chicago. With that, my good friend, Tim Geithner.
Thank you, Ram. It was gracious. Nice to see you all. I want to thank John Canning and Donna Sarconi for hosting this event, bringing you all together. Great to be out of Washington. I don't know if you guys have any politics in Chicago. Probably not, but it's nice to be here. Nice to be in this great city where so many cool things are happening. I share a certain affinity for Ram in many ways. Definitely share his impatience with many things in life. We were both known early in life for our skill in profanity before people came to appreciate our other talents. As you know, the president arrived in Washington at a particularly dark moment in American history. The U.S. economy was contracting at an annual rate of about 9%, and growth around the world was collapsing. And the actions that had already been taken in the fall by Secretary Paulson, by Chairman Bernanke, had broken the back of the financial panic, but the financial system was still frozen, and the economy was still deteriorating at a really alarming pace. And the president did not sit around hoping the fire would burn itself out. He didn't commission a bunch of studies. He didn't play politics with the crisis. He chose to act, and he acted very forcefully. And his strategy to repair the financial system, combined with the Recovery Act, the restructuring of the American automobile industry, and the coordinated global rescue he led in the G20, alongside the actions of the Federal Reserve, were remarkably effective in restoring economic growth. Within just 3 months of taking office, the pace of economic growth began to slow, the pace of declining growth began to slow, and by the summer of 2009, the American economy was growing again. So let me just make this clear. Within about 6 months, the economy went from contracting at an annual rate of growth, annual rate of about 9%, to expanding at an annual rate of nearly 2%, a swing of about 11 percentage points. So in a remarkably short period of time, we were able not just to prevent a second Great Depression, but also to begin to lay the foundation for a stronger foundation for future growth, to begin the long and fragile process of repair. So how has the economy performed since that early start? Since the summer of 2009, the economy's expanded at an average annual rate of about 2.5%, adding almost 4 million private sector jobs over the last 2 years. And growth has been led by private demand, including strong gains in investment, in private investment and exports. The balance sheet of the business community, the business sector, is exceptionally strong. And the economy as a whole, the average American worker, is more productive than it was before the crisis. Now, these are promising developments, but we still face some very tough challenges ahead. Unemployment, of course, is still very high. The housing market remains weak. Growth is not as fast as we would like. And these are the legacies of the financial crisis. We still live in a dangerous and uncertain world, one reason why gas prices are higher today. But what does this early pattern of growth and recovery tell us about the economy over the longer run? Most view the moderate pace of the recovery and the slowdown in growth we saw in 2010 and 2011 as justification for pessimism. But if you look at the causes of the slowdown, there's reason to be more optimistic about the strength of the economy and the American private sector. Most importantly, economic growth in the early stage of recovery was dampened by the headwinds that follow all financial crises. Recoveries that follow financial crises are slower, as Carmen Reinhart and Ken Rogoff have famously written. They're slower because the causes of the crisis, typically a large rise in borrowing by households in the financial sector and too much investment in housing and real estate, act to hold down growth as they are unwound. As people bring down their debt burdens and raise their savings rates, they spend less. As banks are forced to reduce risk and restore more prudent lending standards, they lend less. These forces work against the impact of lower interest rates, dampening the otherwise powerful effects of monetary policy. There's a paradox in this, in that the changes necessary to unwind the causes of the crisis and lay a more lasting foundation for future growth necessarily slow the pace of expansion. Our economy is still in the process of deleveraging, dealing with significant burdens of household debt, these excess investments in real estate and other forms of debt. But we're making a lot of progress working through those adjustments. Household debt relative to income is down about 17 percentage points since before the crisis. Financial sector leverage is down dramatically, and credit is now expanding again. Housing and commercial real estate construction is starting to pick up after 5 years of contraction. And overall, we've done in the United States a much better job in making these adjustments. Martin Wolf, the columnist for the Financial Times, has written that the U.S. economy is the most advanced in deleveraging. Now, apart from these difficulties, these challenges, we face a series of other challenges to growth in these early years of recovery. There were the three large external shocks to growth in 2010 and 2011, the crisis in Europe, the effects of the earthquake, tsunami in Japan, and higher oil prices. And these shocks were large enough to take about a percentage point off GDP growth in the first half of 2011. Their effects are now receding, although Europe and oil still present risks to the U.S. economy. But the U.S. economy proved pretty resilient in the face of those pressures, as growth strengthened quickly as those shocks receded. On top of this, of course, President Obama came into office inheriting very large fiscal deficits, swollen to levels well beyond any experience since World War II. And that erosion in our fiscal strength left the nation with less room to maneuver and increased the political opposition to fiscal actions beyond those in the Recovery Act. And while the Recovery Act provided absolutely essential support to economic growth, state and local governments were forced to cut back dramatically, and that fiscal drag at the state and local level offset a significant part of the effects of the Recovery Act. But that drag, that fiscal drag at the state and local level, is now receding as revenues have started to rise with economic growth. Just one final fact, just to remember. The debt debate last December caused huge damage to confidence across the country. The shock to business and consumer confidence was as large as you typically see in a recession. But that was a blow caused by political threats of default by the president's opponents. It was not something produced by weaknesses in the American economy or weaknesses in economic policy. Much of the political debate in the United States today fundamentally misreads the underlying dynamics of the American economy. If you listen to this debate, you hear many claim that the basic foundations of American business are in crisis. And yet, business profits are higher than before the crisis and recovered much more quickly than overall growth and employment. Business investment in equipment and software is up by 33% over the past 2.5 years, growing much more rapidly than overall GDP growth. Exports have grown about 24% in real terms over the same period. And manufacturing, of course, is coming back, with manufacturing payrolls up by more than 400,000 since the start of 2010. The business environment in the United States is in many ways better than many of our major competitors. If you measure these things by international comparisons of regulatory burden, the tax burden on workers, the quality of legal protections for property rights, the ease of starting a business, the availability of capital, the broader flexibility of the economy, or the productivity of American workers. The challenges facing the American economy today are not primarily about the vibrancy or the efficiency of the business sector in this country. They are about the barriers to economic opportunity and economic security for many Americans, and about the political constraints that now stand in the way of better economic outcomes. And these challenges can only be addressed by government action to help speed the recovery and repair the damage remaining from the crisis, and with reforms and investments to lay the foundation for stronger future economic growth. And that means taking action in the short term to support growth, helping Americans refinance their mortgages, investing in public infrastructure projects. And it means making the investments and reforms that are essential to a stronger economy in the future. Investments in things like education to help Americans compete in the global economy. Investments in innovation so that our economy can offer the best jobs possible. Investments in infrastructure to reduce costs and increase productivity. Policies to expand exports. Reforms to improve incentives for investing in the United States, including reform of our business tax system. A growth strategy for the American economy requires more than promises to cut taxes and spending. We have to be willing to do things, not just to cut things. To expand exports, we have to support programs like the Export-Import Bank, which provides financing at no cost to the government for American businesses who are trying to compete in foreign markets. To make us more competitive, we have to be willing to make larger, long-term investments in infrastructure, not just limp forward with temporary extensions. Any credible growth agenda has to recognize that there are parts of the American economy, like the financial system, that need reform. Businesses need to be able to rely on a more stable source of capital with a financial system that allocates resources to their most productive uses, not misallocating them to finance unsustainable booms in real estate. Cutting government investment in education and infrastructure and basic science is not a growth strategy. Cutting deeply into the safety net for low-income Americans is not financially necessary and cannot plausibly help strengthen economic growth. And repealing Wall Street reform will not make the economy grow faster. It would just make us more vulnerable to another financial crisis. This strategy is a recipe to make us a declining power, a less exceptional nation, and it's a dark and pessimistic vision of America. The President's strategy, as you know, is a different strategy for economic growth, and he believes that while our long-term fiscal problems are formidable, we can address them over time with a balanced package of reforms that preserves room for investments that are important to allow us to grow in the future. There is no economic or financial case today for using the fear of our long-term future deficits to cut as deeply into the core functions of government, to weaken the safety net, or to fundamentally alter the Medicare benefit as do the proposals of the president's opponents. Our fiscal commitments are unsustainable over the long run, but we can't put those challenges above every other challenge facing the country, and we have to confront them carefully and wisely with a balanced mix of spending cuts and modest revenue increases, such as the President, Bull Simpson, and every other bipartisan group that looked at this have proposed. Now, this economy is gradually getting stronger. If you listen carefully, you can hear the hum of the engine of the American economy working again, but we still have some very tough challenges ahead. And yet, as tough as they are, these are manageable challenges for the United States. And I would prefer our challenges to those of any economy anywhere in the world. We can afford, as a country, the investments that are important for future economic growth, and we can adjust to the changes that will be compelled by the need to bring down our long-term deficits. And as we face these important, consequential political and economic choices ahead, remember, and don't let people forget how terrible the crisis was. Remember that Americans are still living with the damage caused by that crisis. And when you listen to the debate about taxes and about Medicare and Medicaid, remember that even before this crisis, about 20% of children in the United States were living in poverty, and about 40% of children born in this country were born to parents covered by Medicaid. Remember that the fortunes of children born in America today, the quality of the public schools they attend, the quality of the health care they receive, the chance they have to go to college, still depends significantly on the wealth of their parents and the color of their skin. But also remember that we're a country of great strength and resilience. We've successfully navigated the most dangerous phase of the worst economic crisis in generations. And we have to bring the same creativity and force and sense of national purpose to the economic challenges still ahead. And that will require better choices from our political system. No economy can be stronger over time than the ability of its political leaders to come together and make tough decisions. Thank you.
Thank you, Secretary Geithner, for those remarks and for visiting us today. This is a new format. You probably recognize it. So think of me as kind of a frumpy Charlie Rose. Okay. So our tradition is to solicit questions from members of the Economic Club. So the dumber questions come from them. I have a few of my own in here. You'll be able to recognize those. But let me start off. Critics of Dodd-Frank compare it to Sarbanes-Oxley as an overreaction to an admitted serious crisis. Are you satisfied with the legislation, and has it adequately dealt with the too-big-to-fail issue?
Good question. And you can never be totally confident you get the balance right in these reforms. And we made a choice, the President made a choice to move very early to put in place reforms to legislate those reforms early before the memory of the crisis faded. But I'm very confident that these reforms get to the core vulnerabilities in our system that caused the crisis. And I believe that if they had been in place in the decade previously, this crisis would have been much less severe, much easier to manage, caused much less collateral damage. And, the core, just was worth remembering what the core of these reforms were designed to do. We had a financial system that grew up outside the safeguards around the banking system. Huge amount of consumer credit was originated outside those protections and safeguards. And you had a huge amount of risk build up outside the traditional banking system. That system grew to be larger than the banking system itself, with none of the safeguards and protections we put in place after the Great Depression. And when the storm hit, that system came crashing down as funding evaporated, and that put a huge amount of pressure on the rest of the economy and caused the most damage we'd seen, in generations. And what the reforms at their core do is give us the authority to limit leverage with more conservative capital requirements for the institutions that pose the most risk to the economy, and to bring transparency and oversight to the derivatives markets, to provide consumer protection on a level playing field across everybody who's in the business of lending money to individuals, and to give us better tools to dismember and unwind large institutions that make mistakes, can't survive on their own, but to do that without leaving the taxpayer exposed to any risk and without leaving the rest of the economy vulnerable to the collateral damage that could come from their mistakes. Those are the core reforms, and we're making a lot of progress putting in place the architecture of rules to enforce that, and we're trying to do it carefully, make sure we get the balance right. We have a great strength in this country, which is these rules have to go out for extensive public comment before they're finalized. We get a lot of feedback on these rules, lots and lots of feedback, lots of advice, and it'll make the rules better.
In the lessons learned from the 2008 financial crisis, are there any systemic risks either to the financial system or financial institutions that haven't been dealt with either by appropriate legislation or regulations?
I think the biggest source of unfinished business in the financial reform effort is in the housing finance area. It's not a source of systemic risk now because those institutions, the GSEs, Fannie and Freddie, were brought under conservatorship, and I have the authority to give them enough capital that they can do what they need to do in this system. But as you know, we're much further behind in laying out the future path of reform in the housing finance system, what should replace those institutions. And that's going to be politically challenging. But if you listen carefully to the debate in Washington, hard to tell because there's so much noise in that place. There's the early signs of bipartisan consensus on what are pretty sensible reforms to those institutions too. So we'll get there.
Now, there are a number of proposed rules and regulations emanating from Dodd-Frank and Basel III. And in your opinion, how will these changing rules and the capital requirements particularly impact the current economic cycle?
No negative impact that's material in our judgment. Remember, what do these rules do? They do the most important thing to make financial systems more resilient in crisis. They force the largest banks to hold more capital against risk and to fund themselves more conservatively so they're less vulnerable to a run, to financial panics. And because we've moved so forcefully and so aggressively early in our crisis relative to what's happened throughout history, certainly relative to what you see in Europe today, to move so quickly to force banks to raise capital, not just to repay the taxpayer, but to make sure that they had larger cushions of equity. Our banks are much stronger today than they were before the crisis, and they're able now to finance the expansion that's coming, and they're able to, frankly, they're strong enough now to compensate for some of the weakness you're seeing from European banks as they delever and withdraw. So I think these reforms and the way we fixed our financial crisis left our system in a much stronger position than it was before the crisis, and in a much stronger position now than our, you could say, our competitors are in the other major financial centers around the world.
Now, I believe you in the past have estimated that at year-end, the simultaneous expiration of tax cuts and the broad spending cuts will amount to about 5% of GDP. In your view, what do you see as a realistic, achievable compromise that the president can reach with a Republican-controlled House? And importantly, if there is an impasse, what are the consequences?
Well, I think any solution to our long-term fiscal problems is going to require some balance between revenues through tax reform and reforms on the spending side. I don't think there's any feasible economic case for doing it without that balance, and there's no plausible political paths for doing it without that kind of balance. In the basic framework the president laid out, we have about $2.50 of spending cuts for every dollar in revenue increases, and the revenue proposals we set out through tax reform would affect a very small fraction of the American taxpayer, just 2%, and a very tiny fraction of the American business community, people who are in a best position to absorb that part of the burden of bringing these fiscal deficits down over time. Now, as you know, so far the Republican president's opponents have not been willing to embrace significant revenues, even through tax reform. And until that happens, I don't see how you break this logjam. But there's lots of ways to get through the end of the year without doing a lot of damage to the economy. And our hope is this collision of expiring tax cuts and the automatic cuts in the sequester will give a very powerful incentive to politicians in Washington to come together and make another substantial down payment on this long-term fiscal challenge. But I don't think it's going to happen without a broader recognition in the business community, in the financial community, and across the country that you need to have some balance and fairness in this basic package for it to happen. Now, we agree, of course, on a lot of what's necessary, but what separates us now is standing in the way of putting together something that would be really sensible for the economy.
Now, taking that balance of cuts and taxes, $2.50 for one, I believe you've said to reduce our deficit to sustainable levels, it's about $4 billion.
$4 trillion.
$4 trillion, rather.
If you go back to where we were last summer, you need about $4 trillion over 10 years to get our deficits down to the level where the debt stops growing as a share of the economy and starts to come down. We agreed last summer on about $1 trillion of cuts across the government, but we have $3 trillion left to go. And for that remaining $3 trillion, what we proposed is to split it roughly 50-50 between broader reforms to entitlements and some modest revenues through tax reform.
And that's where I was heading. What would be the cuts in entitlements, or the reforms?
Well, what the president laid out in September is a very detailed set of cuts, savings, let's call them savings, reforms to Medicare and Medicaid, combined with a very substantial amount of savings to other programs, farm subsidies, civil service retirement, other things that where we have unsustainable commitments over time. I just want to make just one point on this about the question on revenues, because I know it's so central. Think about it this way. If you don't, we're proposing as part of a balanced package that reduces long-term deficits and locks in reforms to the entitlement programs. As part of that, not separate from it, as part of that, we're proposing to raise about 1% of GDP in revenues. That's about $1.5 trillion over 10 years. Bowles Simpson proposed, by the way, $2 trillion in revenues over 10 years. We've got somewhat more modest ambitions. But you ask yourself two questions as you think about these competing proposals. First, ask yourself, if you're not going to do that with revenues, where are you going to find the $1.5 trillion? Are you going to take it out of other core functions of the government, out of defense, out of Medicare benefits, out of low-income programs? It is very hard to do so. It's just very hard to do. I don't see how you can justify doing it. It would be deeply damaging the capacity of government to do things governments have to do, and I think it would be deeply unfair. So ask yourself first, if that doesn't feel right to you, where would you find another $1.5 trillion in savings over 10 years? Can you justify that economically? Is it fair to ask the middle-class Americans to bear that burden? Can you find a plausible political path to get there? I don't think so. I just don't think it's possible. And ask yourself this second question, which is, can the American economy can it handle another 1% of GDP in revenues? Of course it can. The changes to effective tax rates required by that are very modest. They would still leave the effective tax rates on the richest Americans at levels that are very low compared to where they've been over much of recent history in the United States. The American economy did exceptionally well at periods when they were roughly that level over time. So if you don't like these proposals for tax reform, remember, life is about alternatives. These are about alternatives. You have to ask yourself, what would you support? Where are you willing to find another $1.5 trillion in savings? Are you willing to go to Medicare benefits? Are you willing to go to defense? Are you willing to go to low-income programs at a time when poverty is the highest levels it's been in a terribly long period of time? And ask yourself, too, whether those cuts, even if you could do them, wouldn't be more damaging to economic growth. I think they would be.
$1.5 trillion, it's not even worth fooling around with the carried interest on private equity. But we can do that offline. Hold
on. I think that's a very good point. Thank you for that. And again, when you listen to this debate, just when you listen to this debate, remember that there are things we could afford, might have been afforded in the past, we can't afford in the future. It's just not fair. I mean, we used to think you could borrow to finance very low rates of taxes, effective taxes, on investment income and on wealthy Americans, that we could borrow to finance them indefinitely, and we don't have that option anymore. I mean, really, are you thinking in this context it's possible for us to go out and borrow the $1 trillion over 10 years it would cost us to extend the Bush tax cuts for the top 2% or on capital income or sustain carried interest? Can you ask us, could you ask me or my successors to go out and say we're going to go out and borrow $1 trillion over 10 years to finance in this context? Not a chance.
Bowles-Simpson look good now? I mean, would that be an acceptable compromise?
Bowles-Simpson started this debate, and this debate, when it ends, is going to end on terms very similar to that broad balance. All the bipartisan proposals that have looked at this fiscal challenge have come out roughly in the same neighborhood. Revenues through tax reform, entitlement reform as part of a balanced package over time. The mix is slightly different, as I said, let's talk about Bowles-Simpson relative to the president. The president proposed somewhat smaller amount of revenues as part of a balanced package, $1.5 trillion over 10 years relative as compared to $2 in Bowles-Simpson. He proposed more modest defense cuts because he's the commander-in-chief, took a careful look at it, didn't think he could justify going deeper on defense. And Bowles-Simpson proposed some changes to Social Security which cut too deeply into benefits for future retirees, more deeply than you need to cut in this context. And for those three reasons, we started in a somewhat different place than Bowles-Simpson. But every other bipartisan proposal that's looked at this question has come out roughly in the same neighborhood as where the president is and where Bowles-Simpson is, and that's where the debate's going to end. But when it ends, how quickly it ends will depend on whether the business community of the United States and the president's opponents come to recognize that the only way to get this done politically and the only fair way to do it economically requires the recognition, the reality that you're going to need to generate a modest amount of additional taxes through tax reform. I just don't see how you do it otherwise.
You know, there's so many moving parts. Under what circumstances do we face a debt ceiling crisis again?
Excellent question. Thanks for raising it. I said in my remarks, that the threat of default hanging over the country, first time in our history at this level, was incredibly damaging, just enormously damaging to confidence. And hugely unfair in its effects, of course, because when that happens, it means unemployment's higher, more people are looking for work longer, and demand across the economy is weaker in that context. And we cannot go through that again. And the Congress is going to have to make a decision probably at the end of this year to raise the debt ceiling again. Of course, as they would have to do no matter what. Even, of course, under the Ryan budget plan, Congress would have to raise the debt ceiling by trillions of dollars over the next 10 years. And Congress has got to figure out a way to separate politics from the basic question about whether this country meets its obligations over time. And of course, I hope that they decide to do that this time.
How would you characterize the progress towards rebalancing global trade and capital flows since the financial crisis? Pretty good, pretty encouraging. To think about it this way, China's currency is appreciating gradually in real terms against the dollar. It's up about 13 to 14% against the dollar in the last 20 months in real terms. It's up about 40% against the dollar in real terms over the last 5 years or so. Their trade surplus is down dramatically, China's, as a share of the economy over time. And our current account deficit, the amount we borrow from the rest, was also down dramatically over that period of time because Americans are saving more and borrowing less, which is good. So those are promising changes in the basic structure and the basic pattern of growth globally, but we want to see this one sustained, of course, and that means that we have to keep making progress on improving our basic long-term fundamentals. Long-term fiscal deal would help that, and it means in the Chinese case that they have to make sure that they're putting in reforms that make domestic demand construction stronger, and they dial back more significantly the really extensive set of subsidies they have in place for their still very state-dominated economy. So we have some work to do, but pretty promising initial changes. Unfunded pension and healthcare liabilities at the state and municipality level are in the trillions of dollars, and solutions will have to be a combination of benefit cuts, taxes, layoffs. How concerned are you about this looming issue as far as our economic rebound goes?
I would say less concerned than I would have been 3 years ago or 2 years ago or even a year ago, in part because, again, you're seeing states that had to do a lot of tough things, and you're seeing revenue start to move in the right direction now, which helps lessen some of the risk of acute further cutbacks in basic services that would hurt the economy. And I also would say if you watch, if you don't agree on the way it's being done in lots of different states, there's some pretty promising examples of governors. I won't mention any particular ones, but there's some particularly promising examples of governors starting to make some difference in those long-term commitments, and that's what it's going to take across the country.
Let me switch over to Europe for a second. Europe's response to the crisis is heavy on austerity and short on growth policy alternatives. What are the global implications of a prolonged period of stagnation or recession in the Eurozone?
Let's start with what's good, because Europe has made a huge amount of progress in the last 6 months or so, calming the financial tensions across the continent and putting in place a more credible strategy for dealing with this mess. You know, they've got new governments in Spain and Italy, even in Greece, making very, very tough economic reforms, not just to bring down fiscal deficits that are unsustainable, but to put in place reforms to make it easier to start a business, things that matter for future growth. You've got a very creative and aggressive central bank helping make sure banks can fund. They've taken some steps to help recapitalize their financial system a little bit late, not that aggressive, but still welcome. They have in place what they call a fiscal compact now, which is a set of rules and disciplines for reducing the risk that the improvements in deficits today are unraveled in the future. And they've got a new firewall they announced last week, larger firewall to stand behind those governments. And those are promising, very important steps towards calming the financial tensions and reducing the risk this crisis poses to the United States and countries around the world. But as your question implies, they have a long way to go. It's going to be a very fragile and uncertain process, terribly politically difficult for them to go through. And that's why these, what they call a firewall, the combined actions of the central bank and governments through these funds are so important, because those need to be in place and fully credible to give those governments some time to put their reforms in place and for them to get some basic traction. But it's going to take some time. And you're right to point out that this balance between growth and austerity is a very difficult balance to get right. Just to bring back to the United States, it's important to recognize that the biggest mistake governments make in financial crises is to put the brakes on too precipitously and too quickly at the earliest signs of life in the economy. And that's what's killed recoveries and lengthened them and increased the ultimate cost of crises in many countries around the world. And we're not going to make that mistake in the United States. So as you look at, just one last thing, if you look at these contrasting strategies for how you think about our long-term fiscal problems, just remember that you have to phase these things in over time. And if you do them too abruptly, you'll end up undermining growth, making the economy weaker, and making it much harder to make more progress over the long run.
I think you were referring to the recently announced 700 billion euro emergency lending. Is that big enough? And is the bank crisis there different than the European crisis?
Well, they're very related, of course, as you know, because if people lose confidence in the government, and that affects the government's ability to borrow, then that hurts the financial system, of course, as well. And the capacity of those countries to solve their problems, to solve a financial crisis, is weakened if the governments themselves lose the confidence of investors. And that's what happened across Europe the past 18 months or 2 years or so. And the reason why these firewalls are so important is they need to stand there behind as a backstop to the reforming governments, so they have some room to move and put those reforms in place. So the firewall they've announced last week is a larger, substantial increase in their firewall, and it's another step. It's just another piece of a series of actions they've taken in the last 6 months or so that should help provide a more durable calming of the financial tensions, and that's, of course, very much in our interest.
Their recently announced unemployment numbers were a disaster, worst since the euro has become a currency. What's your long-term view of the euro itself? Well,
they're doing the things they have to do to make it more viable over time. You know, they had a currency union put in place without the fiscal complements you need to make currency unions work, and without a unified, coordinated approach to the financial sector as a whole. And they're trying to fix those or complement that early monetary union initiatives with those reforms. And all the other things they're doing in reforms are a necessary part of making monetary union more viable over time. And I think they've thought about this question a lot, and they've decided, the leaders of Europe have decided they're going to do whatever it takes to make this work and make it hold together. And they can do that. They have the ability and the resources to do that.
China's infringement of international intellectual property standards is widely reported, and there are many skeptics of China's desire to curb the infringement and defend foreign innovation. What is the U.S.'s response to protecting the competitiveness of our global businesses?
Well, we've been very aggressive in using the tools we have in U.S. trade law to protect the interests of American business, both in terms of actions we take them to in the WTO to challenge their practices that are unfair, but also in using the full protections available under U.S. law. And we're going to keep doing that. And what we're trying to do is to not just get the currency up more rapidly over time, but to get them to provide much stronger protections on the street against piracy and theft of intellectual property. And as I said, to dial back and substantially reduce the full complement of other subsidies they have in place in China still. They have what in many ways is a world-class manufacturing sector today. And they're a very large part of the world economy today. And it is not tenable for them to be competing with that level of support from the government in this more open, integrated world we have today. It's not fair to China's trading partners, not fair to the United States, and so we're going to keep pushing them to address those concerns.
It's difficult to determine what the appropriate value of a currency should be. Does the Treasury Department determine whether China's currency policy gives it an unfair advantage, and what criteria does the Treasury use in making that determination?
You're right, it's a difficult judgment to make, but what the IMF does, and we really look to them in this as the neutral arbiter, the umpire in this case, is what they do is they look at a set of different measures, models of economic fundamentals, and really all those models still show that China has an undervalued currency, less undervalued than it was, but still undervalued. And the other things you can look at in this context is you look at how aggressively does a country need to intervene to hold the currency down, to resist those market pressures. And China's been intervening a little bit less aggressively the last 6 months or so. But still, they're running a policy, even though they're loosening up these controls, that's still designed to slow the pace at which market forces are allowed to push the exchange rate higher. And that's a good measure of undervaluation.
China continues to be the largest foreign holder of U.S. Treasuries. Does that concern you? Does that complicate some of your ability to take actions?
It doesn't concern me. It's a good question, though. We're typical. We're like most other major economies in the sense that roughly half of the debt held by the public is held outside the United States, and we're the masters of our fate as a country in this context. And what matters most to us as a nation in terms of how we do economically over time will be whether we find the political will and the political consensus to continue to make some progress bringing down these long-term deficits over time. The world today has a lot of confidence in the capacity of the American political system to ultimately get this thing right and do it soon enough. But we want to make sure that we earn that confidence. And that requires, it's going to require Washington figuring out a way to put politics aside and start to make some more progress on these long-term fiscal problems. But we can do that. We have the time to do that.
There are reports that the federally guaranteed student loan programs, which have grown from $79 billion to over $700 billion in the last decade, will be the next fiscal crisis. What are your thoughts on that?
I don't think so. It's good. It's a good thing to pay careful attention to in this context, but it's worth recognizing a number of different things. Most of those numbers are distorted by the fact that the Washington changed the way we do student loans, and instead of guaranteeing them, we decided to provide them directly, which saves much more money for the taxpayer and provides much lower cost of credit to the student trying to afford college. So most of what people see as a precipitous increase in debt is just the change in the structure of those basic programs. And it's still again, if you look at the basic reality of compensation in America, if you go to college, you earn much more over your lifetime than somebody who stops their education after high school. And it is very rational for people to borrow to make the investment necessary to go get those skills and training. Very rational choice, and we want the financial system of the United States to make that possible over time. But that also requires that students make informed decisions about whether the education they're paying for is good enough to justify that investment, and it requires that we put better protections in place, as the Consumer Financial Protection Bureau will, to make sure that students at that vulnerable time in life are not being taken advantage. It's much harder for a family to pay for college by borrowing against their house today than it was before. And so you want to be very careful as more people go to college, which you hope will happen, and more people have to borrow to afford the cost of college. They're able to make better informed choices, and are protected from the kind of abuses we saw in the private markets and lots of other consumer finance in the years before the crisis. But again, overall, what you're seeing is a good thing. More appreciation of the higher returns to education, more people finding a way to go to college, community college or four-year college. Lots of innovations, not least in Chicago, trying to make sure community colleges are doing a better job of connecting people to business with the skills they need. And those are good investments, and they're investments that should be supported by the government because they're very high returns to society as a whole. You wouldn't want to cut deeply in them. And where people have to go to private lenders to borrow for college, you want to make sure they have some basic protections against abuse and predation.
Data suggests that people who have been unemployed for over a year face significant challenges in obtaining comparable employment again. Do you think that one of the problems is the unemployment benefits have been extended so long, or are there other structural issues?
Not a material contribution. Remember, those benefits are very low. They're just a fraction of the salary you had beforehand. So it's very hard to make the argument that people would voluntarily choose to earn 40% of what they're earning before and stay comfortably on that for a long period of time. Very hard to do. It's very hard to live on that benefit. Unemployment today is high because of the aftershocks and legacy of the crisis. And the best way to bring that down over time is to get the economy growing more rapidly. And that's something that requires governments doing sensible things to provide better incentives for growth in the short term. That's why we focus so much on, again, not to compliment your mayor again, but why we focus so much on infrastructure nationally, because infrastructure, there's a very good case for infrastructure. It's good policy for growth, good for business competitiveness, gets more people back to work, concentrates employment opportunities in parts of the country still most affected by the weakness in construction more generally. Very good case for those things. Again, when you think about high unemployment, remember two things. One is that it's the legacy of the crisis, the aftershock of the crisis, and to get it down over time more rapidly requires getting the economy growing more quickly. And you need better outcomes from Washington, just an example, in infrastructure and education to achieve that outcome.
Why do you think the current administration has a reputation among business leaders for being anti-business?
People ask me all the time.
That wasn't my question.
Yeah.
That was one of somebody out there.
Yeah. I'm not an objective, independent observer of these basic questions, but I don't think it's justified or fair. And let me just again remind you, look at the basic health of the business community in the United States today relative to 2007, for example. So look at level of profitability. Look at the rate of growth in investment in equipment and software. Look at what's happened to productivity. Look at expectations of future profit growth. Look at how broad the strength is in the American economy today. It's in energy. It's in agriculture. It's in manufacturing. It's in high tech. If you look at profitability and expectations about profitability in the sectors of the American economy where we're forced, I think compelled, to put in place reforms, profitability is pretty high in those parts of the American economy. I'll give you just one more example. Remember, we're a $14, $15 trillion economy every year in the amount of income generated, amount of output generated. And if you take even the most extreme political estimates of the cost of regulation, ignore their benefits. Ignore the benefits of food safety or clean air. Ignore the benefits. Just look at the direct costs. They are a tiny, tiny fraction of output and profits in the American economy today. So, if you have to measure us by the choices we made, and you have to measure us by the outcomes achieved in this context. And it is very hard to make the case on the basis of the evidence that what ails the American economy today is a private sector weakened by those other challenges. Very hard to make that case.
You know, one of the things that many of us hear are the amount and increasing amount of regulations, and that looms as a very cost in effect, a very production constraining thing. You have Dodd-Frank, which still has a lot of rules to be enacted. You have the healthcare law, which has a lot of rules to be enacted. What can be done to address this issue? I know the president announced an initiative.
Well, of course, you're right that this president, for what I believe are very compelling reasons, has in energy, in healthcare, and in the financial system laid out a set of reforms that are going to be very consequential. But again, look at measures of profitability in healthcare. They're doing fine. Look at the reforms in the financial system. They're tough reforms. Of course they're tough reforms, but they're tough where they need to be tough. And again, if you listen to the giants of the American financial system today and listen to what they tell their investors about their capacity to manage a business with these reforms, they're reassuring about this. So I do not believe there is a credible argument that those reforms, where they happen, and they have to happen in those cases, are proving to be a material disadvantage to this economy as it recovers from crisis. It's not an argument for not being careful about how the reforms are done, and I'm sure there are going to be regulations. I'm sure that's the case. I'm sure the regulations that exist today that we inherited, and I'm sure there are ones working through the pipeline that could be done better over time. And so we have an obligation, anybody in government, to try to make sure we get them as carefully designed as possible. And not everybody's going to like them. But again, my judgment, just take the financial system again. They are absolutely necessary to protect the economy from the risks that caused the worst financial crisis in the Great Depression. And we have an obligation and responsibility to make sure we get those reforms, again, tough where they need to be tough, but still sensible in providing a balance between the resilience and stability you need and the of course, efficiency we all want to still see, creativity, innovation we want to see in our financial markets.
Now, you were on the firing line and right in the midst of dealing with the crisis at the New York Fed in 2008. And you came to Washington in November of 2009, and as you call it, the dark days. I haven't seen the pressure let up on you since then. How do you cope? They can't be hanging around with guys like Rahm.
Well, I work with incredibly talented people, incredibly strong, tough, brave president, and I've always loved my work. And generally, you know, it's not hard when you're part of something that matters to the future of the country and you're trying to make tough choices about things that could be terribly damaging to the country. Those are things that are overwhelmingly compelling, and they certainly offset the other burdens that come with the office.
Now, you're going from here to the Chicago Ford stamping plant?
I am.
Tell us a little bit about that and why you're here and what that symbolizes.
Part of what we try to do is to help illustrate for Americans the many sources of strength in the American economy today. And the automobile sector, because of what the president did, and manufacturing more generally, is one of those signs of sources of strength, or parts of strength in the American economy. I'll just give you another example. Autos, of course, you all live with. But, if you listen carefully, you can hear companies, major manufacturing companies, starting to bring back manufacturing from China or Mexico to the United States because they look at the relative strengths of this country today. They look at how fast costs are rising outside the United States, and they see the competitive playing field shifting more in our favor, and that's a really encouraging thing. So I'm going to Ford, but I do this across the country all the time, to try to not just get a better feel for what's happening in the economy, and as you know, autos are really very strong now, but also to help illustrate at a time when Americans are still, again, living with the scars of the crisis, still more uncertain about this economy, to try to illustrate to people what's encouraging, what's promising, so that even though people understand that we're still living with some really tough challenges as a country as a whole, if you look at the underlying dynamics of this economy, there are lots of things that are pretty promising in the future. And again, that is because this president moved so aggressively alongside the Fed to break the back of that financial crisis and to do some tough things earlier, very difficult political things earlier in the recovery to make the economy stronger. And the economy is getting stronger because of those policies. And we got a lot of work to do, but it's good to point out to people where there's signs of strength.
I have one final question. Who is a better basketball player, you or the president?
He's an excellent. I'm not a basketball player, really. Right. He's an excellent basketball player.
Secretary
Excellent
Geithner,
basketball player.
thank you very much for coming, but thank you for your service to the country.
Thank you, John.
That was great. Thank you very much. You did a great job.